Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be discussing Learn How to Profit from Share Trading, the All Ordinaries Index and this week's Stocks of Interest. Now before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. So let's get into this week's report. When it comes to learning how to profit from trading the share market, it is important that you understand who you are and how you approach your trading, as this will enable you to manage yourself and your trading rules much better so you consistently profit. But herein lies the issue as to why most are not profitable. Let me explain. A few years back I launched an inexpensive 11-lesson course called Trading Mentor, which was designed to introduce people to some simple but powerful strategies that would enable them to learn how to profit from share trading on a consistent basis. The reason for this was because of a number of people who were contacting us simply wanting to learn how to buy and sell. In their mind, they were thinking if they learnt some rules that allowed them to just buy and sell, that this would teach them how to win more than they lose. Now, while on the surface this sounds logical, no rule works all of the time in all markets. Instead, different rules are used for different markets. And there is so much more that needs to be considered when buying and selling than just rules alone, which is why I wrote the Trading Mentor course. When talking to these people, I found that the majority were not achieving their goals because they had been influenced by many market myths, in that they had false or misleading views as to what trading actually is, the best way to become a trader, and or what they needed to know in order to become profitable. Interestingly, quite a few said that they were traders, while others had been dabbling in the market for several years, and most, if not all, had read books, completed one or more weekend courses, or scoured the web looking for that holy grail, and yet they'd still not learnt the strategies that would allow them to become profitable on a consistent basis. In fact, a common question that is asked by those new to the market is, can you tell me what the best share trading strategy is to use? Now, when somebody asks this question of me, it tells me that they are just not really a trader, not just yet anyway, because if they were, they would already know how to implement their own strategies that would deliver the results that they are seeking. Now, it also tells me that they haven't gained sufficient knowledge to learn how to profit from share trading, or they haven't put in the effort to develop the skills to be able to work this out. But irrespective of whether you are new to trading, looking to get into trading, or have been trading for some time, let me share with you 7 strategies that are invaluable to you if you truly want to learn how to profit from share trading on a consistent basis. No doubt if you're a regular on my YouTube channel, or you've read a number of my articles, you would have heard me say that trading the share market successfully is not about how much money you make on any one trade, it's about how much you do not lose over time. In other words, it's about minimizing risk, not maximizing profits, and the most efficient way to minimize your risk is to set a stop loss. Now, a stop loss is simply a price point where you want to sell to preserve capital if a recently entered trade turns against you, or to protect the profits of a winning trade. Now, unfortunately, most traders either don't use stop losses or they don't know how to set them properly, and therefore they get stopped out way too much. Many are also poor at actually exiting trades, even when a stop is triggered, and as such they are largely unprofitable over time. So my number one rule is to always protect your downside risk. Now let me ask you, if you were about to have brain surgery, would you prefer an intern or a highly skilled surgeon with 10 or more years experience? I often ask people who tell me that they're traders if they would give all of their money to somebody with their level of skill and knowledge to trade, and the answer is always a resounding no. Yet the majority don't see until it's too late that their success in profiting from trading is directly correlated to their level of knowledge and skill. Now, most would agree that developing any new skill or technique in life is something that is developed over time. And learning to trade is no different. Just having knowledge about a technique is not enough, because there is a vast difference between knowledge and understanding. Knowing what a trend is does not mean you can make money from it. But understanding how you make money from it and developing the skill to do so is the most important skill you can develop. Sadly, most traders do not put in enough time and/or effort to achieve this. Many falsely believe that because they've learnt about a technique in a book that they will instantly be profitable. Yet this is so far from the truth it's not funny. To be successful, you need to test the technique and, more importantly, your ability to use it properly so as to build skill in applying it correctly in the right situations. So rule number 2 is to put in the effort by gaining the knowledge, skill and experience. And I guarantee if you do this, you will succeed. Now there's an old saying that you get what you pay for, which definitely rings true in the share market. Another is that your education will cost you one way or another. Now all too often I find those starting out wanting to trade Forex, options and contracts for difference because they mistakenly believe that they can make more money quickly and with less capital. And while this is true for experienced traders, it is the opposite for the inexperienced, as they don't have the required knowledge or expertise to trade these highly leveraged markets successfully. The key to profiting from share trading is to take a slow and steady approach and to build your knowledge and skill over time, so that you're in the market long enough to gain the experience needed to ensure your longevity in it. Now, would it surprise you to learn that the life expectancy of a trader attempting to trade these highly leveraged markets can be measured in weeks and months, not years? Think about it. Would you get onto a plane where the pilots only just read a book on flying? Now, it's unlikely because the risk would be way too high. Well, the same applies when trading highly leveraged markets. It requires you to have a high level of knowledge, skill and experience. But it does explain why those who do not possess these attributes end up going down in flames. So rule number 3 is to always follow rule number 2. Now there are 2 emotional vehicles that drive the share market, and they are fear and greed. Now greed dominates the emotional landscape of traders when times are good, whilst fear dominates when times are bad. In a rising market, many people leverage to the hilt, trading just about anything that moves, with the rising market generally hiding their mistakes. However, just as leverage can significantly increase returns, losses are also magnified, particularly in a falling market. Now, unfortunately, those new to the market are often enticed by fancy marketing gimmicks and the potentially high returns that can be gained from trading Forex, CFDs, options, warrants and futures, yet most fail to make anything. This is because the streets become littered with wannabe traders who have lost their capital and sometimes more through the overuse of leverage, poor skills and fear. Given this, as a general rule of thumb, if you cannot profitably trade blue chip shares on a consistent basis, do not attempt to trade other instruments because the results can be and sometimes are devastating. So rule 4 is to always leave a safety margin when trading leverage markets, in case things go wrong, which means to avoid using all of your available funds. Now we've all heard the saying, don't put all your eggs in one basket, and there is a good reason for this. Simply because if you place all of your money in a trade and that trade goes bad, you stand to lose all of your money. And yes, I have seen many traders do exactly that. So it makes sense to diversify your money, but how do you do that? Rule number 5 is to always have 90% of your capital in a medium to long-term portfolio of high-quality stocks and only ever use 10% to invest in highly leveraged markets. Now, the 90% invested in medium to long-term portfolio, holding between 5 and 12 stocks, and always be prepared to go to cash if the market warrants it. Of the 10% invested in highly leveraged markets, never hold more than 4 positions at any one time, so as to minimise your risk, and only ever invest 80% of that available capital, leaving the remaining 20% in the event of a margin call. Now, did you know that the logical part of your brain is much smaller than your emotional side? But if you want to make smart decisions about money, you need the logical side to dominate. Yet the opposite is normally the case once a hint of fear or greed sets in, which is why we see otherwise intelligent people chase that get-rich-quick fantasy or hang on to stocks that have lost significant value. We've seen many times in recent history what the onset of fear and greed can do to individual stocks and the financial markets the world over. But there is a way to avoid getting caught on the wrong side of this, and that is to have a solid plan in place as to how you will manage yourself and your investments so that you minimize any potential downside both financially and emotionally. So rule 6 is once you have a plan, stick to it. Success will happen when you apply the first 6 strategies. However, your long-term success requires you to also spend some time on self-exploration. And this is why knowing your why, or at least one thing that is driving you to want to trade successfully. For most people, this will be about family, lifestyle, or a personal challenge. Now, you may be thinking that you've heard all this before. However, if that's the case and you still haven't applied yourself to the task, then my message has probably come to you at the right time. Remember that really successful people set goals, and this not only allows them the freedom to focus on what they want, but more importantly, in the process of setting these goals, they really come to connect with their why, which creates a powerful, motivating force to achieve their goals. So rule number 7 is to follow all of the rules above, because I guarantee that if you incorporate these 7 strategies into your overall approach to learning how to profit from the share market, you will dramatically increase your chances of success. And if you are serious about learning strategies that will enable you to profitably trade the market on a consistent basis, I encourage you to enroll in my Trading Mentor course. So now let's get stuck into this week's stocks.
Please remember that this report is an educational tool, and as such your personal circumstances have not been considered in the analysis of the compilation of the shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, please pause this recording and view the disclaimer on the screen. We hope that you enjoy this week's report.
Okay, today it's Friday, not Monday, that I'm actually recording these stocks because Monday here in Australia is a long weekend. So at the point in time, just a little precursor to the stocks that I'm looking at the moment is they've got Monday to Thursday data in it. It's actually Friday morning here in Melbourne. It's about 45 degrees, so you can see me getting a little bit hot, so because the studio does get quite hot at normal times, let alone 45 degrees. But just keep in mind, when I'm talking about the market and stocks, we don't have Friday's date in it, and I did record this on Friday, the morning of the 25th of January. But got a few emails or comments from our viewers, viewers over the last few days from last week's video. I'm going to go through those as we do that. But if you've got any comments, if you want to ask me about a stock, that sort of stuff, just go down below there and type in your comments about the market or anything else. I'm quite happy to take all questions, quite happy to answer those. But on your screen, you should be seeing now, I'll just put my glasses on, a weekly chart or weekly bar chart of the All Ordinaries Index. Now, in my last reports, I was expecting our market to probably have a couple of down days this week, and I'm still thinking, at this point in time, I still believe our stock market is bullish through to this first quarter. At this point in time, as you can see on your screen here, the current weekly bar, which finishes today, as I said, today's data is not in this. It opened on Monday at 5941, currently closing at 5930. So it's down about 11 points for the week, which is not surprising to me. As I said, I did expect maybe 1 or 2 days down. We also have seen we've got that low there on the 20th of January, or it was on the 20th of December. Sorry, I've got my tongue tied. For that week ending the 28th of December, the market's moved up around about 8% in that time, and I think it's around about 4 to 5% in January. Generally, there's an old saying that if January is really good, the rest of the year will be a very, very good year, and it's unusual to see the All Ords have negative years, consecutive negative years, and we were down about 7% last year, roughly, if you're reading some of my reports on my website, etc. Having a look at this, I still think the market is bullish, as I mentioned. I'm just going to go down to the daily chart briefly just to show you a little bit about what I was talking about, and there's some stuff we teach. Oop, I went too far on that. It just scrolled a little bit too far. The stuff I teach in our Trading Mentor course, and obviously in our diploma course in a lot more detail, really to how to understand these bars and how markets unfold. When you're trading the market, it's about price, pattern, and time. There are 3 components that you need to understand. Most people just look at price alone, or don't even do that. They just sort of think, they hear some news and then they start trying to trade, or they read reports, that sort of stuff, and try and trade. If you've got some basic skills underneath you, you'll absolutely cream the market. You'll do better than everybody else around you, because most people, when they look at trading the stock market and look at trading itself and buying and selling stocks and or other instruments, they do so with very, very little knowledge, understanding, or even a solid process and plan. But what I was suggesting that our market had to have a couple of days down this week, and you can see here that the 22nd, 23rd was down, the 24th, which was Thursday, it was up strongly at 24 points. It was up closing at 5930. Now, we might get another day up here on the Friday. It may start to move down, but the current recent high was the 21st of January there at 5975. And you can see markets unfold in regular little patterns from low to low to low to low. And that's what I'm talking about, timing the market. You're talking about price pattern and time. That's one of the major components. So at this point in time, we are moving up. I am expecting the All Ordinaries Index, if I go back to that weekly chart, maybe have one more week up, but I am expecting 1 or 2 weeks down anytime now. Could be next week, could be the week after, but I am expecting 1 or 2 weeks down. So I expect some of the stocks that have been moving up just to slow down a little bit. That's really what I'm saying. But it's still, whilst I haven't confirmed that the 20th of December is the low that I was looking for, it is highly likely, and once we get a downward move to test it and the market shows me support or levels of support in price, time and pattern, then I'll start calling it, going, yes, it's definitely in. This year's going to be a little bit more bullish. For a lot of you, just to let you know, I pretty much ignore most of the news in the marketplace. I know a lot of people, type me emails that and talking about this is happening, that's happening, people are talking about this. I pretty much ignore all of that. I watch the charts. The charts tell me exactly what's going on, and that's why I can be very distant from the market in terms of that and not being emotionally affected, which affects my decision making. The charts are a purer form of understanding the psychology of the market, because the reason why I know that is every stock that's bought is also sold, and things only move when things are bought and sold. You can talk about it all your life, but until somebody changes money to somebody else, nothing's happening. So to me, don't trade on speculation, trade on confirmation. And the charts tell me the confirmation. That's what we're looking for. So right now, market's looking quite bullish, but don't need to jump too early, especially on the banks. I know people are thinking, the banks, because NAB, National Australia Banks, I think paying about 11% dividend yield. CommBank is looking okay, but the banks, stay out of them at the moment. Wait for the Royal Commission, wait for the dust to settle, then have a look at them. And that's probably I think the Royal Commission's out 1st, 2nd of February. So have a look at it, see what the market thinks, and then get into them if they're still looking good. So wait for that. This week I'm going to, if I just scroll down on my list here, you probably can hear my laptop humming away there. Let me have a look. I'm doing A2 milk first. I've got a few, as I said, a few comments from my thing last week. Let me just pick up that. So this is from, I think it's Ramit. I can't say your surname, Ramit, so please excuse me. But Ramit says, "Hi Dale, do you see A2 milk?" That's the stock on your screen right now, and Kogan shares going up before Q1 2019. If so, by how come? I think you mean by how much. I think that's what you're asking me. Another analyst said that Kogan might go around $7 and A2 milk will go above $13 by the end of February. I personally don't see that happening. Thanks. First thing, Ramit, is price projections are great, but they mean absolutely almost nothing to you. So having an analyst tell you a price projection is pretty irrelevant to me. And to me, another thing that I was saying last week is pretty much don't necessarily listen to experts. You need to have a process and a strategy for yourself for getting in and getting out. Never set price targets or saying, I'm going to buy because it's going up to $13. If you don't own it now and you're looking to buy it, and if you're looking at the screen here, if I go to, where is my little tool? This little tool, from where it is now, it's closing there at $11.71. To get up to $13, if I go there a little bit higher, we're talking about 11.21%. So it's a reasonable little move, short-term move to pick up 10%. But all too often people set these targets and go, well, it gets to $13, I'll sell out, and they take 10%. But what if it goes to $27? You've missed out on a lot of profit. So to me, it doesn't matter what analysts tell you about their projections. Is it strong or is it weak? Is it going up? Is it going down? If it's going up, hang on to it, work with it, stay with it. If it's going down, get out of it. So from that point of view. So what's my thoughts on A2 milk right now? But let's have a quick look at it. It's done a beautiful little pattern through from its all-time high back. Where is that one? Back in February last year. Came down into a nice little low here. So I think it's looking quite nice. It came down into October. And I'll bring up the weekly chart for you so you can see that. It is making a bit of a nice move up at this point in time. The last few weeks is up. It's really sort of broken above this sort of pattern, so it's looking quite nice. Although this week's a little bit of indecision, I'd expect it to come back down a little bit. It very may well go through that $13 by the end of February, but it may go to 14 or 15 or 16 in the next 6 months. So it's about having a plan, a process. What are your rules? And that's really what I'm saying. But I actually like A2 milk at the moment. I think it's looking okay, but I wouldn't expect it to be blindingly brilliant like it has been. You can see how it really fast mover up until now. The market's caught up to this, so you're probably not going to see the spectacular rise that you saw over the last couple of years. That I think that's the fun in the sun, so to speak, is over. Let's have a bit of a look at Kogan shares now. That was the other one that you did mention to me. Now looking at Kogan, again looking at this stock, now you're saying Kogan $7. Now currently its high here was $4.88. It's got a close at $4.10 at the moment. Now $7 by, well, I'm not sure whether you're saying by the end of February Kogan's going to go to $7 from $4. That's a massive move in the next 4 or 5 weeks. I don't think it'll do that. Most stocks wouldn't do that sort of effort, but it is looking a little bit more bullish than what it has been. Obviously its all-time high is way back through here. It's under a lot of pressure. Consumer staples and consumer discretionary are great performing sectors last year, and they're still doing okay, but and obviously this is an online retailer, but a lot of pressure from Amazon, those and other online retailers coming into Australia. So it went from a high of $10 all the way down to that low back in November at $2.61. So this might be just a rebound, maybe a bit of a dead cat bounce, or it could be a new uptrend right at this point in time. I'm not sure. One thing that worries me about the current weekly bar, if you have a really good look at it, you can see it open. It kept right up to open at $4.83, and currently it's down at $4.10. So it's completely reversed this week. If I go down to the weekly chart, you'll actually, the daily chart, you'll see that this big move up on one day and it's fallen the last few days. I'd like to see it find some support there, and to do that, what we need to see is a couple of down weeks and a bit of support, and then start to move up. So if I did that and then it moved through this high here at 487, I'd get a little bit more excited about it. Right now the jury's out a little bit. I don't know whether you own it or you don't own it at this point in time, and it's probably not necessarily relevant, but if you do own it, no reason to sell it. Same with A2 milk, but if you don't own it, I probably wouldn't be jumping into it right now. And A2 milk, if you don't own it, I'd be looking at that, whether you'd get into it. But also, as I said, look at it as the strategy that you have. Do you have solid buy rules? Do you have some solid sell rules? What's your plan? What's your process? If you don't have that, doesn't matter how good the analyst is behind the recommendation, you still will struggle to make money consistently. Ramit also had another question just before I move on to the next one. So Ramit said, hi Dale, also for the long-term investment and using the power of compounding, would you suggest investing in shares directly or ETFs such as Vanguard? Is ASX a good option? At least it will represent the market. I'm not a fan of ETFs, Ramit. I'm actually an advocate of buy directly into the market. So to me, investing in shares directly will always give you a better return than an index ETF. Index ETF is just another word for a managed fund. That's all it is. So back in the GFC, everybody had managed funds. They all lost a lot of money. So the industry really needed to rebrand themselves. So they come up with this word, exchange traded funds. Let's float the fund on the exchange and everybody can buy and sell them a little bit easier. Still the same sorts of funds though. If it's an index fund, last year the market went down around about 7%. So if you had an index fund last year, your fund would have gone down, or your index fund would have gone down around about that same sort of area. But Interestingly, if you look at the top 200 stocks on the market, about half of them went up in 2018. So if you look at the top 10 stocks and you buy and hold them over a 10-year period, you'll outperform an index fund based on the All Ordinaries Index, because the top 10 are the market. So, but they'll outperform because they're not having stocks going down, pulling them back. You're always better owning the top 10 stocks. Have a look at my book, Accelerate Your Wealth. It's your money, your choice. Get online on our website, wealthwithin.com.au. Buy the book, go to the bookstores or get on Amazon and buy it. Read it and you'll understand what I'm talking about is why not use ETFs. Go directly. Also, buying an ETF and holding it for the long term is not compounding. It has nothing to do with compounding. You're just buying something at a price and selling at a different price later on. Compounding is when you buy from low, sell high, then pay your tax, then come in and buy another thing, and then buy low, sell high, and you're compounding your return by turning it over. You'll make far more money again by doing that, and that's really what we teach through our trading mentor course: how to buy and how to sell, how to compound your return. And if you look in the book, we outperform the market dramatically during the GFC and everything in the book, and we share with you how to compound your returns just with direct shares, just with the top 20 shares. Really safe, not high risk. So have a good look at the book from that point of view. So thanks, Ramit, for your questions. Got any more? Just punk them down below. Happy to chat with you. Mr. Poker Kid 89 sent me an email or sent me a message down below. He said CM8. He said, let me have a read of it. I'll just bring it up on the screen while I'm reading it. So here's CM8 charts. He said, CM8 ASX. Hi, Dale. I'm looking to open a position on this stock I'm looking to open a position on this stock and looking to hold into the next 1 to 2 years. They recently made a pivot in a business strategy in late 2018. They moved away from telecom into global social media. Sounds like telecom, Telstra. They did that sort of stuff as well. So from telecom into global social media advertising campaign. They are now one of 6 companies worldwide that can help companies advertise directly on Snapchat. Snapchat itself isn't an amazing looking business model, but with CM8 having a relatively small market cap, this one contract, if worked correctly, could get CM8 off on a good start on their new business model, hoping for long-term above-average market gains for 1 to 4 years. Basically, Mr. Poker Kid, just not to be rude to anybody, but everything you just said is just pure speculation to me. None of it's solid strategy. There's no fundamental analysis in there. Is it making money at all? What's its earnings per share? Does it pay a dividend? What's its debt to equity ratio? What's its PE ratio? All of those sorts of things will start telling you this sort of stuff. If you know this sort of stuff and the market hasn't moved this stock, generally what people find out is they start getting all this information from chat forums and everything else, and they jump onto these stocks hoping to pick a winner and something that will outperform. You are far better in CSL than you are in this stock, and this is a really, really low cap stock, and I would even almost call it DOG as a stock in terms of that. But just looking here at that weekly chart, you can see all these bars through here. Straight away I see this is a very illiquid stock, and I'll move down onto the daily chart in a second. Second thing I notice is it's in a downtrend, and it has been in a downtrend for such a long time it's not funny. So since August 2015 it had a high of 36 cents. Let's expand the chart up, having a look at this. This is a stock that nobody should own right now in my book. And so looking at the current weekly bar, as I said, we're looking at the weekly bar. So if you're looking at the 25th of January, as I said, today's the recording, so it's got data to the 24th of January. It's at 3.5 cents. It opened and it closed at 3.3 cents, so 3 cent stock. Here's the really alarming thing to me. Have a look at the volume. It says 611,603 shares were traded. Multiply that figure by 3 cents. Doesn't get to a lot of money. If you're looking at it, I don't have my calculator with me, but that's not a lot of money. If I go down onto, that's for the whole week too, not just for a day, for a whole week. So if I go and look at the daily chart now, wow, that really alarms me looking at this sort of stuff. See, when you see dashes like that, that means there's maybe no trading at all, or 1 trade for the day, or maybe 2 trades or 3 trades for the day, all at the same price. So when you get these dashes, that tells you a stock is seriously illiquid, not mildly illiquid, it's seriously illiquid. Because when you buy something, you want to be able to sell it at a fair price, and you won't be able to do that with this stock. Because as I said, it may be one trade, maybe two trade, but it's not hundreds or thousands of trades that you get on bigger stocks, the liquid stocks. This is highly liquid. Again, 88,180 shares traded for the whole day. Multiply 3 cents into that. It's not a lot of money if you want to do that while I'm talking to you. The other thing I'm looking at here is if I look at the date. So let's have a look at some dates here. 3rd of January. Then the next one I've got is the 4th of January. Okay, so that's the next day. 7th of January there. We got the 8th of January. I'm just checking to see. There's the 11th. Where's the days missing? So there's days missing here. And I don't have, the data is up to date. What's happening is there's days that this stock doesn't even trade. That tells me it's on the bottom end of the liquidity scale. And it's even more so, it's actually not the bottom level. It's probably not even worth looking at. Well, to me, it's not worth looking at. It's probably one of the worst looking stocks I've actually seen. The third thing I look at is how far it can run in a day and what's its volatility. And you can see here that one day it went 33.3%, but then the opposite happens. You need to understand that it can move and move around. So if you bought in near that top thinking I'll get into it, and then you wanted to sell out, let me just click on here. Between the close of that day and the opening the next day, it was down 4.5%, and within a few days it was down a fair whack in price. So you really do need to consider that. Let's quickly have a look at a big stock. Where's another one? Let me go. Let's have a look at CSL here. So let's have a quick look at CSL. Let's go down onto CSL. Let's go down to the daily chart on that. And we'll have a look at the volume on this. Now, this is a $200 stock, and people go, oh, I don't want to buy a $200 stock. It's expensive. Well, no, it's not. If this is worth $400 and it's trading at $200, then that's really cheap. But if a 3-cent stock is only worth half a cent, that's really expensive. So the price of the share has absolutely nothing to do whether it's cheap or expensive or how much money you make. Did you know if you bought CSL off the float when it first hit the ASX using its first price on the ASX and you put $5,000 into CSL that day, you would be a millionaire today? Do you know that CSL has run thousands of percent and done very, very well because it's a big company, it's well managed, very, very liquid, much, much safer. But looking on a daily chart, let's have a look at this last bar here. 688,000 shares were traded, but a lot of trading was actually happening. And if you multiply $200 by 688,000, that's a lot of money. So you can see here on a daily basis, it's 600,000 shares. Now, looking at CM8, you'll find a whole inconsistency with liquidity here. You need to look at bigger stocks. You need to look at big blue chip stocks. The chances of you getting CM8 right, or anybody getting CM8 right, including myself, any of the highest experts, I'm never going to get CM8 right. I'm going to guess it all the time, and if I do make money out of it, it'll just be pure luck. It won't be good management. It won't be good process. Rich people don't do things like that. Successful traders don't do things like that. They buy good stocks, they have a solid plan, and they know that that plan will work the majority of time. That's where stocks like CSL, Cochlear, all of those things are really, really good. Because you look at this, let me go back to the weekly chart so you can see a bit of more of a run. If you look at this is a beautiful run. If you want a stock for a couple of years, look at this, from 2016 to 2018, I made 153.97%. CSL averages about 36% per annum since it's floated. So you're talking a stock that's absolutely kicked ass, basically. So you don't need to take high risk. But really, thanks very much for bringing my attention to that stock. I've never seen it before, and highlighting a really nice educational opportunity for everybody. Again, I'm not trying to be rude to you or anybody about the style of stocks you do, but you need to have better rules than just conjecture, which is what you've written to me on here. Have some solid rules. Just got an email, I think, another comment today or yesterday. Hi, Dale, bought your book. What's amazing is I actually read it from start to finish and couldn't put it down. So he's talking about Accelerate Your Wealth, I believe. I have another 3 stock trading related books, all of which have been started and never completed. Okay. And I'm taking your advice and have started rereading from start again to ensure I completely understand. That's a really, really good way to do it. You need to go over it a few times because there's a lot of depth in Accelerate Your Wealth to really help you understand the market and trade better. Wish I'd read it before spending a fair bit of money on a video training via someone else. That is too complex for me to remember, let alone execute. It's something I hear all the time, and I get a lot of people, they buy a few videos for a few $100s on the web and they think they're making a lot of money. And it's quite easy for somebody to put their t-shirt on, set themselves in front of a camera and tell you how great they are as a trader, buy a couple of books and just teach you what's in those books, but they don't really understand it. And when you don't understand something, you make it really complex. There's only real experts that can make the complex seem really simple. So that's how you tell a good educator, somebody that makes everything sound quite simple for you, that you do understand. And so thanks for those sorts of comments. As I said, I wish I'd read it before spending a fair bit of money on video training via someone else. That was too complex for me to remember, let alone execute. Once I have some trading under my belt, I hope to join the Trading Mentor course. Thank you. Well, thanks very much, Ian, for the nice comments. So if you do want my book, just go to our website, Wealth Within, Amazon, or in your local bookstore. wealthwithin.com.au is our web address. Again, place your comments below. If you want me to look at stocks for you, happy to do that. If you've got comments, questions, please do that. Remember to like the video. Hit that like. It really does help us. And share the videos. Love for you to do that. But that's it for this week. I'll talk to you next week. Take care. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillam, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.